The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and/or legal advisors before implementing any transactions and/or strategies concerning your finances.
Hi, my name is Alex Chacho. I'm an associate advisor here at Ullman Associates, and today I'm going to be talking a little bit about risk-adjusted portfolios. So what is a risk-adjusted portfolio? It is an investment strategy that really seeks to balance the risk that you're willing to take and the growth that you are trying to achieve in your investments. And so how does that kind of work? Um, the difference in risk really comes down to, for most investors, the difference between investing in stocks and being in the stock market and investing in fixed income like bonds or treasuries or money markets, things that are less likely to lose you any money, but are also more likely to not get as much money compared to stocks if you pick the right ones. And how you choose that depends on a very different number of factors depending on who you are. It's a very personalized thing. Take me for example. I am 28. I'm a young person, and I have a lot of time left before I will really need to take out money or use money that I'm going to invest for living expenses, or I'm not looking to buy a house or anything. So I don't need this money in the short term. I can probably handle a higher amount of risk, and if the stock market is going down, then I don't really need to take money out. Then it's okay that my portfolio may go up and down over time because I don't need to access that money for a while. Whereas if you take someone who is retired and is in their 60s or 70s and is using that money to fund their expenses, then they are less likely to take on a lot of risk because they need to use that money. If the stock market goes down or in their portfolio takes a hit, even if it's just for a temporary period of time, if they need to take that money, then if they're don't if they're over invested in the stock market, then you're kind of forced to take losses that otherwise you could have maybe waited and not had to take, if compared to like myself or someone else who doesn't need to use the money. So going back to the example of how I'm not looking to buy a house, so I can take on a lot of risk. The other example would be for a younger couple or someone who is looking to make a large purchase and expects to take money out of their investments to fund like a down payment on a house. Then you would want to take that into consideration and adjust your portfolio to be more on the conservative side, be more invested in bonds or a money market where you can take that money out pretty much at any time and expect that you're going to at least not lose any money, but while still getting some return back because you're expecting to make a purchase and make use of that money in the short term. And another thing to consider when it comes to risk adjusted portfolios is diversification. So what you want to do once you figure out how much money you want to put into the stock market and how much you want to put into bonds or other conservative fixed income investments is which stocks you want to buy. So you don't want to put all of your money into one or even just a couple of companies. I think everyone's heard the term before, don't put all your eggs in one basket. You want to spread out your investments over a number of companies and a number of sectors, such as healthcare, technology, or industrial, just to spread out where your risk is, because not every sector and not every company is going to have the same gains and the same losses compared to each other at any given time. So if you have a spread of your investments, if you need to sell stock to raise some money for purchases or funding your yearly expenses, then you can pick and choose which ones are doing well and make sense for you at the time, instead of being locked into just a specific thing that may have done poorly in the short term and you don't have any choice at that point. So that's why you kind of want to make sure you're diversified to a good extent. And on the other hand, you also don't want to be over diversified where you have like a very large spread of investments to the point where you're not even capturing the various gains that some companies are going to see. If you're very lightly invested everywhere, you're going to miss out on the gains that happen in a certain number of stocks because you just don't have enough money in it to really make it worth it. So you just kind of have to consider what you're willing to buy and what you're not willing to buy and make that decision on your own kind of. And another thing to consider when it comes to planning out your portfolio and making sure that it's risk adjusted for you is the psychological aspect, which is something that you probably may not think about as you're getting into it, is what are you comfortable with? You want to pick investments that you are confident in and that you understand what you're doing and why you're doing it, so that if the market goes down or if something happens, that you're not surprised and panicked because you're not sure in what you're doing, and maybe you sell or make an impulse action that negatively hurts you, where if you were confident in what you were doing and you can make a more controlled decision, that you would have a better outcome in the end. So what that kind of means is, although you may think that you want to take on a lot of risk because you're trying to get as much gain as possible, you don't want to do that if that comes against how comfortable you are. Because if you're all in the stock market and you're just looking for as much gains as you want, then if the market goes down and you panic and you sell stuff because you see your portfolio value going down, then that's going to hurt you just because you're making an impulse decision because you're just kind of winging it and you don't really know why you're invested in what you're invested in. And so at the end of the day, a risk-adjusted portfolio is not about just minimizing the amount of risk you want to take or playing it safe all the time. It's a personalized strategy that really depends on what your goals are, what your financial needs are, and how much risk you need to take to achieve those. So if we consider risk on a scale of 1 to 10, and you need to take a level 5 amount of risk to reach your goals, whether that's buying a house or funding your kids' education or just going on vacation every year, then what you need to take is 5 amount of risk to meet those goals. You don't want to take more risk than that. So if you're taking a level 8 or 9 amount of risk, then you are beginning to risk not meeting your goals entirely, because you're more likely to not meet your goals and potentially lose money or just not make as much money for really no reason. If you can meet your goals while keeping yourself at a certain standard of risk, there's no need to go over that to try and get more if it's not going to achieve anything that's really helping you in the long run. We're really just looking to get a certain amount of long-term growth that's needed for your goals and your financial needs. Thank you for watching my video today. If you are interested in more content, we have more videos on our YouTube channel, and if you're interested in anything in the future, please subscribe. If you're interested in other written work or other content from our other advisors, we have more content at JGUA.com. Thanks again, and we'll see you in the next video.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at JGUA.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.